Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, I'm talking with Angus Shillington, the Deputy Portfolio Manager for the Active Emerging Markets Equity Strategy at VanEck. Angus, great to have you on the show.
Hi, great to be here.
So, Angus, you recently wrote that within emerging markets, the India story really stands out. What makes investing in India so compelling to you?
That's a huge question. I have always believed, and I think the data supports that belief, that India's a great investment. Certainly when you look back, I don't think a lot of people understand this or take the time to understand it. The performance has been astonishing. Over 10 years, it's pretty much the same return in US dollars as we've seen in the United States. So I think to date, it's 160% up for the S&P, and it's 150%, I think, for India. But if you look over 10 years, India's returns, again, in US dollars, are almost twice as much as you've gotten in the S&P. So that would be my first point. And then the second point, if you think that's good, I think what's happening right now in India in terms of sort of social digitization reforms probably makes that better. I think that's sort of the core of my thesis or belief.
So that's interesting. And what's driven those strong gains? You mentioned, matching the U.S. Over the past decade, outperforming the U.S. over the past 2 decades. Is it the GDP growth we're seeing, the demographics? Because we've seen, strong GDP numbers in other emerging markets, and it doesn't necessarily always translate into strong gains for stock markets, right?
Yeah, and I think that's really sort of the crux of this conversation we're going to have, that GDP doesn't necessarily result in returns, and you can really sort of go back quantitatively and assess that over time, and the cohort of Indian businesses, like in the US, have compounded value, right? So on one hand, you can have a country with a large GDP, and on the other hand, you can have the companies in the index not deliver value to shareholders. That is not the case with India, and I think that's where it's important to start the conversation in the past. And I think if you want to sort of look at it through the lens of why has the US been a great market, and I think good GDP, good demographics, India maps that with probably slightly higher GDP, which probably talks to the 20-year number. But I think the important thing is the cohort, right, that makes up the index. And indexes are sort of living creatures, right? So the better companies get better and the worse companies get less good, and the index tends to represent over time the collection of the best companies, right? So in the US, it's obviously a large cohort of innovative, oligopolistic businesses with great brands, moats, pricing power, and they grow nicely over time and compound value. That's pretty similar in India. So I think that's really the sort of the core of the conversation here, is that you want to invest in a company that is not only exposed to a country that's growing and a demographic that's positive, but you want the companies within that index or ETF or a single company to actually deliver real dollar accruing value to a minority. Otherwise, what's the point?
Yeah, that's a great point. And I want to get more into how to invest in India and things like that in a minute. But before I do, I was reading through some of your tweets, and I know you visited India not too long ago to take a look at, what's happening on the ground. Can you talk a little bit about, some of the changes that are happening over there, major policy shifts, infrastructure build-outs, things like that?
My big takeaway, my big observation was the opportunity appears to be larger than I thought it was. And I already had a pretty optimistic scenario built in, yet the appreciation of that appeared to be the same or less. And I think this is an important point, that as a country is developing, and usually along the same patterns as a developed country, right? So if you think about the lens that we see the US, a lot of what India is doing right now, we have experienced in the US. Now, there's some very positive factors by being a last mover and coincident technology and that kind of stuff. But I think that was my real observation on the ground. Now, you don't need to go on the ground to really sort of track policy. And Modi came in nearly 10 years ago. He won on this sort of platform of growth, of eradicating corruption, of, taking care of everybody in India, right? And, what I saw on the ground and what I sort of see even looking in from the US is those policies have been astonishingly successful. So, and I think the way to look at policy is how it builds, how it accrues over time. And as you layer policy on top of policy, what is the sort of outcome? What's the compound effect? And, the policy really started with slightly before him with identifying people in India digitally. So thumbprint, retina scan, who is everybody? And I remember seeing that it was shortly before Modi came in and thinking, oh my God, this is huge. This is game changing, because if you can actually identify a person and answer the question who, it's very similar to GPS in the US answering the question where. You can start to do a bunch of very valuable functionality on top of that. So he then took that, ran with it, and used that to do what he called the policy called Jan Dhan. Jan Dhan was everyone had to open a bank account, right? Super easy to KYC yourself, walk into bank, thumbprint, retina scan, and you got a bank account, and you got a little bit of money for doing it. And then he demonetized, meaning that all the cash in this sort of previously cash economy, which was really not helpful in a couple of ways. One, high cash economies are low tax compliance, so the fiscal budget was underpowered. And then the other one is just like the ability of cash and corruption, allows corrupt governments to buy elections. So demonetizing meant everyone got their money in the banks, and anyone who had money that they'd either stolen or gotten by corrupt means had to burn it, because if they put it in the bank, they were in trouble, right? So that was the next one. And on top of that, we built tax reforms, and on top of that, bankruptcy laws. So bankruptcy laws and tax reforms, compressed overall cost, allowed businesses to scale nationally rather than locally, because the previous chaos of sort of local, super local, taxes that were partly corruption, all stuff made up nonsense, disappeared, and you saw one visible taxation platform. And then as time went on, with new bankruptcy laws, the banks could clean themselves up, creating more credit for the economy. And then I guess the last piece is when you sort of pull all that stuff together, you've now digitized transactions. You digitize transactions, tax capture goes up, the fiscal budget improves. Last year, and most interesting, I think this is my last point, is 2022, tax revenue growth. So let's tax revenue growth was twice as fast. So in percentage terms, was twice as fast as GDP growth. So if you let that sink in and think about it for a moment, if you're getting more in than the economy is growing, then your budget is growing quicker. And you take that budget and you build infrastructure. And once that infrastructure is in place, you suddenly find transport, logistics, and the whole thing is a flywheel. So that in a nutshell is what we see happening. Is so taking that difficult, somewhat broken, problematic, corrupt economy, which has delivered great stock market returns because of the companies, the quality of the companies, and now you're creating an environment where these companies can grow quicker with higher quality. There's more credit in the economy, so it's a big flywheel, and it's extremely exciting.
That's some great color. So it certainly sounds like all the stars are aligned for India, Angus, but one of the big concerns that I hear investors talk about when it comes to investing in India is valuations. Can you talk about what valuations for Indian stocks currently look like and how that compares to other stock markets around the world?
Yeah, sure. I mean, maybe I'll take the second point first, because I think that relative value construct is doing investors or potential investors a real disservice, right? Because saying that China is cheaper than India or Brazil is cheaper, I'm not sure. That's not really the point, right? The point is, what is this opportunity set in isolation? And I kind of think about it like a sort of an automobile analogy. If your pension was earned by driving 20 times across the country over time, and there was a pot of money at the end, and you were offered a brand new Mercedes, which was a little bit more expensive, or a sort of 5-year-old, I don't know, Kia, I would take the Mercedes because it would give me a smoother ride, probably better speeds, more reliable, and it's pretty much guaranteed it would get there, and I could probably sell it at the right price. The other option, who knows if you're going to make it or not. So I think it's about deconstructing the opportunity, and I think that part of this exercise is academic, right? So what have you been paid in the past? What are you going to get paid in the future? So that's a bit of an analysis thing and an academic data thing. And then the question is, what are you getting paid to take a specific set of risks? So I think that's sort of the construct I would think about it. Does that make sense? And I'm happy to drill down into that in some detail.
No, I love that. I love that analogy, and it makes a lot of sense to me. So what about in terms of absolute levels? What are we talking about when it comes to India valuations?
Okay, so let's start with, what do you think is the appropriate multiple? Because I think that's the piece that I think people need to assess for themselves. And I think in doing that, you say, okay, academic, what is multiple? Okay, multiple is the cost of the opportunity. So the opportunity, deconstruct that into, well, it's the volatility, right? So volatility of India, not that far off the US. If you look at 90-day vols over 10 years, India's 14, US is 13, China's 24. So clearly, the India risk piece kind of aligns with the US rather than most of the other EMs. So that's number one. And then number two, you look at the return structure. So what are you getting paid to take the risk? And that's when I think you really sort of things start to get super interesting and again, somewhat misunderstood. So I kind of tend to think of return on equity as a basic sort of shorthand for opportunity. So what is it any company or any index paying you over time? Now the US is over the last, I think, 30 years is somewhere in the sort of 14 handle. That's gone up relatively recently. I think it's now somewhere in 16, 17. India, average of 16, so comfortably above the US, although that range has come down in the last sort of 5 or 10 years for various reasons, mostly around the investment in the opportunity that's building out, but that's now around the sort of 13, 14 range. China has averaged 10, 11 over time, which is okay, but that's fallen sharply over the last 10 or so years. So it's sort of in the 8 or 9 range now. So here's what you got so far. We built out volatility about the same as the US, are much less than China and less than a bunch of the others. So it's different. So let's say that relative piece is already looking out of sync. The return on equity, India looks a lot higher. So again, out of sync. So let's sort of zoom in on the accrued sort of returns piece. And this is where things get kind of super interesting. So a friend of mine, Ajay Kapoor at Bank of America, did a wonderful study, again, looking 30 years out, which is sort of where the data kind of starts, and sort of try to understand what an index paid you, right? And he found there really were only 3 indexes in the world, I say in the world, that actually investors accrued value over time, over that period of time. They were the United States, obviously, India, and the third is slipping my mind. I think it was Denmark, but it was one of those Scandinavian countries, but literally only 3. Now, his measure was relatively simple. He said, okay, let's look at top line growth. Let's look at how much sales and revenue all of these businesses and these indexes over time make. Let's look at how much that is growing. And then let's look at how much of that ends up in EPS. So what is paid to investors as accrued returns. And those numbers were pretty staggering. Over time, India turned about 14% of growth into EPS of about 8 or 9%. So, comfortably compounding and accruing over time. The US not far off those numbers. China had higher sales, but with negative average returns over time. So again, just talking to the quality factors in the India market. So now let's sort of drill down to multiples, and I think that's the sort of the money here. India trades in a range, again, not dissimilar to the US, which is sort of surprising, I think, to a lot of people. At an aggregate level, it's about a 20 handle forward PE. The range is sort of 15, 25, but the median around 20. The US about the same. China somewhat less. So we're getting back to this sort of relative thing. So I think now we've sort of established quality, growth, cohort of great businesses in India, not dissimilar to the US, other EMs, not so much. So I think it's time to throw out the relative piece and sort of back to how do you drive across the country several times. I think, you want to look at an investment, the investment of your savings as a ride, right? How do you want to take that ride? You want to take a ride that's comfortable, that's reliable, that's capable of higher speeds. And if you do, then you're going to have to pay a slightly higher multiple. So the last piece in this, and then I'll throw you back to you, is this sort of notion that there are very expensive businesses in India. Yes, that is in fact correct. Some of the sort of higher quality consumer businesses trade at like nosebleed valuations, and they have performed pretty well. But I think transposing a handful of businesses that are expensive into this sort of notion that the market itself is expensive, as I say, does investors, I think, a pretty significant disservice in keeping them out. And I think, like any investment, we would always encourage individuals to do their homework, to look at the data, to understand the opportunity. And when you sort of, rather than taking somebody else's biases or throwaway comments that may not represent the whole, and you tend to find that this isn't the crazy situation in terms of multiples and risk that are being outlined. It's a market that has delivered great returns. It's a market that has a cohort of businesses that deliver significant annual returns to shareholders. And, the price multiple is not that crazy. So I think that's, as I say, I'm trying to sort of really sort of deconstruct my personal approach to valuation. And I think you've got to be fairly analytical about it. And when I do it, I don't get that concerned. Constructing a portfolio gets a little bit more difficult. Maybe we can talk about that as we go on.
Yeah, super interesting. I really appreciate you giving us that deep dive into India valuations. It certainly sounds like you can, justify these higher valuations compared to other emerging markets. So Angus, you are obviously with VanEck, a firm that offers dozens of ETFs, targeting all sorts of asset classes and geographies. How does VanEck offer investors exposure to India?
Yeah, I mean, that's a great question. So it's a work in progress. We have a couple of ETFs out there right now. One is called Digital India, which has a ticker DGIN, relatively new, performing pretty nicely. What that is a slice of what our ETF guys and believe is the opportunity presented by digitization. Now, this is, again, where you can draw an analog with the United States that, we have been through digitization. We saw this thing play out, and we saw this sort of group of incredible businesses that pre-digitization didn't exist, the Googles, the sort of Facebooks and Amazons. And we have a belief that those kind of trends will present themselves and those kind of opportunities will present themselves. So this vehicle is a long-term exposure to those kind of things. And then we have a one called the India Leaders Fund. So the ticker is GLIN. We slightly adjusted the objectives of that a couple of years ago. So the performance bit is a little bit weird, but that's aimed at really picking the leaders going forward. And I think that somewhat, we're trying to get to an investor value proposition that, especially in EM, has been problematic over time by broad indexes. So India's sort of index churn hasn't been that huge in the past. I think the index churn will probably become very much more material as digital disrupts, in a similar way to we had in the US. So in the GLIN ETF, what we're trying to do there is make sure we have as little exposure to failure, if you want to call it that, for the guys who get disrupted, and as much exposure as we possibly can to success. So I think, one of the problems we've always had, and this has been particularly problematic in emerging market ETFs, is this notion that, you buy a broad index and you're buying, a slice of failure and you're buying a slice of success. And, the longer run sort of friction of the first over the second doesn't give you the returns that you would expect. So those are the two exposures we have right now.
Gotcha. DGIN and GLIN.
That's correct.
Okay, so Angus, we've talked a lot about India, and for good reason. It's a very important emerging market, but obviously emerging markets are much bigger than just one country. Where else are you seeing opportunities in EM today?
Again, it's a little bit of a setup here. We're certainly in the strategy I work on, we are very focused on companies, right? And, if a company happens to be in the country, then we end up with an exposure to that country. Now, some countries, to us, present less risk than others. So you'll tend to find we have more exposure in those countries themselves. But really, our strategy is aimed to find extremely high quality business that will, as I sort of highlighted in India, will compound value over time. Some of my personal favorite businesses have relatively low compounding factors. So one is a bank that compounds at I think 13 or 14%. But if you own that 13 or 14% compounding value over 10 years, that should pay you 300% if you're careful about your multiples. So just a framework, that's what we're looking for. So we find those really kind of all over. And I think the way we would think of macro risk or macro opportunity, so numerator, denominator, I'm not sure which way particularly to present it, where do those companies reside? And they tend to reside in countries that have much more open policies, open regulatory structures. So, Indonesia, Philippines, Brazil is definitely on an improving trend. Mexico for sure. So I think that again, I'm not answering your question directly, but I'm being very intentional why I'm not answering your question directly. We like a country that has the most of those kinds of companies in it and has the least sort of macro idiosyncratic currency or regulatory risk. And that does put us in Brazil, Mexico, Indonesia, Philippines. We're underweight in China now. We're obviously very constructive in India. Those are our broad thoughts. Saudi Arabia is emerging as a really interesting place to invest with some good exposures in Egypt. So we have actually, surprisingly enough, quite decent exposures in Turkey. Regardless of the currency situation, there are ways to navigate around that. So that's broadly answers your question, but I needed to sort of put it in context.
Yeah, it absolutely does. And you mentioned, Angus, that you're underweight China. That was obviously a powerhouse for many, many years, but over the last couple of years, investors have really soured on that country. Are you underweight, because, the growth situation is deteriorated? Is it more geopolitical? What's the reason for that?
I mean, we get there from the bottom up, and I think the easy answer to that is that these sort of digital businesses, Alibaba, Tencent, Meituan, have really started to run out of juice. Now, that's a combination of saturation, competition against each other, and they're just not giving the returns they gave in the past, but they're still trading at the multiples they traded in the past. So maybe think about that as the inverse of the thesis I just laid out for India. Like, if your business was trading at a 20 times multiple for 25% growth, and you think that growth is going down to 10%, that multiple should not still be at 20%. So we think there are a lot of risks out there for those kind of businesses going forward. And we've certainly scaled back our exposures. But on the other side of that, there are what I would call structural compounding growth fallen angels in China. Great businesses that are compounding value, that are trading at insane multiples, 2+ standard deviations cheaper than they ever have. So I think there's no way you want to write China off as some kind of basket case uninvestable, but I think you've got to be patient for multiples to mean revert. And I think it will need some modification in policy to encourage investors to pay those valuations.
And another emerging market you touched on, Angus, was Turkey. Obviously, a roller coaster over there with the unorthodox policy, and then after the election, a shift back towards more conventional policy. Do you think there's room to run over there? Because the stock market has been doing quite well over the past year or so.
I mean, it's difficult to calibrate because so much of how exciting returns look are based on local currency. So you strip that out, it's still decent. But I got to say, the first time I went to Turkey quite a while ago, having been investing specifically in Asia for quite a while, most of my career, I was astonished about how high quality the businesses are there, how good the management are, how focused they are, the business models. So we found a handful of business models there that fit that quality construct, pay returns to minorities, but will benefit from a weaker currency. So one of them is a hospital company which focuses on medical tourism. So as medical tourism relatively in Turkey gets cheaper and it's a wonderful place and lovely people, it's going to attract more. So the businesses potentially grow quite quickly. Another one is an auto manufacturer that manufactures for European brands predominantly. So as the Turkish currency depreciates, you find that it's cheaper for Renault or some of these guys to manufacture in Turkey. So they see their volumes go up quite significantly. So there are, and I think this is sort of, again, interestingly where you've taken this conversation, which is wonderful, which is you can't make top-down calls, I don't think, anywhere, but specifically EM. There's always great opportunities from any outcome. If you think the Chinese population is aging and there's a demographic issue there, well, you buy, elderly care companies, stuff like that. So I think it's about really sort of understanding the business, and that's what we try to do here, and taking that understanding into deep, rigorous analysis, and where we find businesses that we believe will pay minorities real dollar value over time, and the risk justifies that, then those are the investments we take. So that's really sort of very clearly what Turkey represents to us right now.
That makes a ton of sense to me. Well, Angus, we're going to have to leave it there. It's been an absolute pleasure having you on the podcast. Thanks so much for sharing your insights with us.
You're welcome. Thank you for the invitation.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.